Hello. Oh, welcome to the cold of December. Nice to be with you all today. I wanted to talk to you today about year-end savings tips. So, year-end tax planning, I think it doesn't get as much attention as I wish it would because it is really a way for people just like you to save really a substantial amount of money, especially when you consider that it's something you can do every single year of your life and therefore get the compounding effect of saving money year after year after year. But I'm bringing you a series. This is episode 3 of my year-end tax savings tips. I just wanted to bring you some bite-sized nuggets to really help you get the most out of your taxes at the end of this year. So today, I want to talk to you about accelerating your business expenses and deferring your income. In other words, this is that episode about the juicy tax deductions. All right, so let's jump into it. So the strategy here, when you own your own business, when you work for yourself, the strategy we're looking at, first of all, is to get your bookkeeping done up to this point in the year. So that is rule number 1. It's very important. The philosophy is you do your bookkeeping early enough, not waiting until after December 31st. Year-end tax planning is you looking at your numbers before the year is over so that there's still a little window of time where you can take a few actions to save yourself money. That's the principle. And when you own your own business, when you work for yourself, you have a tremendous amount of flexibility to do some timing of when you spend your money and when you receive your income. And because taxes happen on a calendar year basis, you can do a little bit of fancy footwork at the end of the year when you own your own business to save money. By deferring income that you know you're going to receive, you can defer it until the new year, and you can accelerate expenses you know you're already going to spend money on, accelerate them into the current year. And what does that do to your money? It gives you a lower taxable profit for this tax year, right? That's the whole point. That's where the tax savings come in. If you report less income because you've accelerated expenses and deferred income, you're going to pay lower taxes. All right. So let's talk about how you do that when you work for yourself. Step number 1, you have to do your bookkeeping. You have to know what profit you actually have and what your taxes would be, right? What your taxes are on track to be for the year. I want to give you a little reminder. I know I talk about this a lot on this podcast, but one of the key reasons that most self-employed people tend to underestimate our tax bill is because we tend to think about income tax, but we forget that we also owe a substantial amount of tax to self-employment tax. So self-employment tax, quick primer, is you paying into Medicare and Social Security when you're self-employed. Now, if you were a W-2 employee, you would pay 7.65% of every paycheck to Medicare and Social Security, right? Going into your own future retirement and health benefit. And your employer would match that 7.65%. They'd match the amount they pull out of your check and they'd match it with their own money, right? And so when you add 7.65 plus 7.65, those two halves, it equals 15.3%. Well, who's your employer when you work for yourself? That's right. It's you. You're the boss. And so because you are the boss when you're self-employed, you have to pay the boss half too into Medicare and Social Security. Now, interestingly enough, you also get the boss benefit on that. Your half that you pay as a boss into your self-employment is actually deductible, whereas the half you pay as the employee is not deductible. And this makes sense because, tax law is applied equally to everyone as much as that's possible, and employees don't get any deductions, right? So an employee doesn't get to deduct their Medicare and Social Security contribution. It's not a tax savings to them. So the tax law doesn't let you deduct the employee half, but it does let you deduct the boss half because you are the boss, in fact, and paying into your Medicare and Social Security, at least on the boss half, is in fact an expense of running your business, and therefore you get to deduct it. Okay, so self-employment tax is 15.3% of your profit. And that is going into only Medicare and Social Security for yourself. And you haven't even started paying your federal income tax yet. Okay. So if your federal income tax rate is, say, an average rate of about 20%, you're not paying 20% of all your profit in taxes. You're paying 35.3% into taxes. Okay. Because of that self-employment tax. So self-employment tax tends to have a much bigger impact on your tax bill when you're self-employed than you tend to realize. This is a mistake I see over and over and over. And I just want to give you that warning straight up front. But there's good news. There is a corollary here, which is when you're self-employed, every dollar you spend on business expenses, so ordinary and necessary expenses of running your business, that's IRS wording, is a deduction off of your taxable profit. Okay. In other words, it's not lowering your taxes by just your federal income tax rate. It's lowering your taxes by your federal income tax and your self-employment tax rate. So your average tax rate plus that 15.3%. So 15.3%. So it can be a lot, right? It can be a really big savings when you spend money in your business. And this is one of the key areas of savings potential that you have in year-end tax planning. So there's two sides to the year-end tax planning expenses income coin. Let's talk about the income side first. I'll touch on that really quickly, and then we'll get to that juicy deductions part that you're probably super interested in. Okay, so again, the idea here is that December 31st is the key date. And what we're doing, you have a little bit of leeway, is trying to push expenses so they fall either on this side or that side of December 31st. In other words, so they fall into this tax year or next tax year. In general, you're trying to push income that you have control over the timing of into next year, so after January 1st, and you're trying to push expenses that you have control over the timing of into this year, okay? Yes, it is going to lower your taxable profit, and you do have to consider other things when you do that because, there may be some counterbalancing reasons. So a good one is if you are a self-employed person and you are, for example, looking to buy a house, looking to get a mortgage. Banks are very conservative giving mortgages to self-employed people. It's an unfortunate reality of being self-employed. They often want to see your income from 3 years, which is a lot. And so you are actually trying to show the bank the highest income you possibly can. Yes, that does mean you're paying tax on that amount of income, but the bank might not be willing to give you a mortgage if you're showing income that is super, super low. Because they want somebody who's capable of paying the mortgage, right? So you do have to sort of balance other factors. I don't want you to go so far in this direction, which I think people tend to want to do, that you kind of screw yourself in other areas. So keep in mind any reasons where you might need to show higher income, and you might not want to take advantage of this year-end tax planning tip. But let's say that you do. Let's say you're not looking to get a mortgage in the next couple of years. Then you're going to look at your income year to date, and you can kind of project out the end of the year earnings to try and sort of guesstimate what that last couple of weeks is that haven't happened yet. So you get a sense of what, in general, your profit is. Okay, so for income, for deferring income, there's a couple different paths that you can take. If your business is one where you can invoice people, where you get your money because you send an invoice and then it's paid, you could simply delay sending out your invoices for a little bit, right? So you might want to send all your invoices out on January 1st, right? If you can pre-schedule them. So that's a thing that you can do that's perfectly valid to send your invoices out after the new year, or even right near the end of the year, right? There's, of course, another side to that where some of your people who are paying you, they want to be accelerating their expenses and they might actually be motivated to pay you this year. So this is a thing to keep in balance. But if you are strictly talking about year-end tax planning purposes for yourself, you can delay those invoices. Another way that you can delay income potentially is if you, for example, are a creative person who gets grants, right? Some very generous grants do allow you to control the timing of when you receive the payment. With grant income in particular, which is taxable income, grant income, it is really important because of the tax year basis of when you pay taxes, it is terrible to receive a grant right at the end of the year before you have a chance to spend the money. Because, of course, any expense you have against that grant is not going to end up being something you pay tax on. And yet, if you receive a grant right by December 31st, right in the end of the year, and you haven't had the chance to then spend the money, you will owe taxes on the whole thing, which could be a much higher tax bill than you honestly are ultimately going to end up having. And so you'll get this uneven quality of a big income reported this year, big tax bill, and then next year you spend the money and you maybe even report a loss because the grant itself you reported in the prior tax year, not the current one. So to control grant income, it can be very wise to if you have control over when they pay you the payment, it can be very wise and strategic to get your grant money at the beginning of the year. Because what that does is the moment that that money hits your bank account, it is reportable for taxes. And you want to be receiving that money the same year you plan to spend it, right? So the longer you have to spend it, the better you are from a tax position. Okay. So if you have grant income that you can control, I would say this is a time to consider deferring receiving that income until after January 1st. Okay. Now, some people ask about, timing issues. There can be some little tricky things that happen at the end of the year. What happens if you receive a payment, say from a client, but you don't cash the check, right, until the new year? Well, I want to just tell you what the tax law says about that. The tax law, the IRS has this rule called the mailbox rule. Okay, so the mailbox rule says that you actually are required to report income in the year it was available to you. And that might be a different time from when you actually cash the check. Okay, so you're not allowed to, get a check in November and hold on to it for 6 weeks until it's the new year and cash it in January so that you can report the income in the following tax year. That is not allowed. That violates the IRS's mailbox rule. I do find that in practice, it does, your taxes do tend to go the way your bank statement went. And so there's sort of a practical reality there where most people do their books based on their bank statements. But I do want to make sure that you are very clear what the actual rule is. And so if you receive a check during 2024, but you don't cash it till 2025, technically you are supposed to report that income in 2024, not in 2025. Okay, so that's the income side of year-end tax planning. You can defer income until later so that it's not going to show up on your taxable income for 2024. The other side of that coin is expenses. So when it comes to expenses, this is where, we love spending money. It's really fun. It can be an awesome thing to do. And of course, you get a big, juicy deduction when you're self-employed. You save not only your federal income tax rate on that expense that you spend money on in your business, you also save that 15.3% self-employment tax. Now, I want you to be cautious as you think of expenses at the end of the year. Be cautious to only spend money on things that are of genuine value to you and not things that you wouldn't have bought under any circumstance, right? These things still cost you money. They're not free, but I do want to just clarify for you kind of what your tax savings is. And I'm going to give you a little tip right now on how to actually calculate what your tax rate is so that you actually know how much you save with every business deduction. I don't think this is clear enough to most of us. So let me just take a moment to make it very clear to you right now. And, share it with all your friends because I'm afraid not enough people know how to do this. So here's how you can actually find how much you're saving on your business deductions. What you want to do is go calculate your average tax rate. Okay. Your average tax rate is the amount of tax you pay on every single dollar, right? Under US tax law, we pay different tax rates on different types of incomes, and we have a graduated income tax system where you pay a different rate on your first $11,000, a different rate on the next $10,000, up and up and up. So tax rates are actually quite complex. This is why if you ask an accountant to talk about tax rates, they take a minute and they look like a deer in the headlights because it's so hard to explain. But you can just take the average tax rate to know a more basic number of, like, in general, across all of your income, when you average it all together, what is your tax rate? And that's a much more useful baseline number to have in your head. Okay. So I'm going to tell you how to find that number. So if you pull out last year's tax return, you're going to look for two numbers on two different lines, and you're going to do a little division, okay? You're going to look for your total taxable income, okay? So the amount of money that you have that is being taxed, total taxable income, that's on line 15, okay? So you're going to note the number on last year's tax return, line 15, total taxable income, okay? Then you're going to look at line 24, and line 24 is your total tax. Okay. Total tax, remember, is the actual tax that you pay throughout, that you've incurred on all your income throughout the year. It doesn't talk about how much you paid. That's in the payment section. But total tax, line 24. So you're going to divide your line 24 total tax by your line 15 total taxable income. And that number is your average tax rate. So look at that number. Whatever that number is right there, your average tax rate, that's how much you save on business deductions. Okay. And I want to give you some real figures. I'll give you a number for my own tax return and one from an anonymous client. Okay. Just for a little comparative baseline. Okay. So when you're self-employed, because of that self-employment tax, our taxes can be kind of high, right? Surprisingly high. And it's that self-employment tax that really tends to push up our tax rate and make it feel extra high, because there's not a third party like an employer, a boss, paying into Medicare and Social Security. So it does bump up your tax rate. And that's the reason, one of the reasons you get that wonderful benefit of deductible expenses. Okay. All right. So I pulled an anonymous client's tax return. I'm not going to tell you anything about this client except for some basic stats so that you understand kind of the income situation. So this is a single person, a single woman earning about $105,000. Okay. And this money, her income, is all self-employed income. Okay. This tends to be the kind of person whose tax rate will end up being the highest. Okay. This is why year-end tax planning is so valuable when you're self-employed. So her income, about $105,000. That's her total, total taxable income, line 24. Her taxes were $26,000 and some change. Okay. So her total tax, I misspoke. Her total tax on line 24, her income was on line 15. Her total tax was $26,000. When you do the math there, when you do the division, that comes out to a tax rate of 25%. So her average, for every dollar that she spends in her business, she actually is saving 25% in taxes. Okay. So it's like if she buys $100, deductible item for her business, it's really only costing her $75. Okay. That is a pretty big discount, because 25% for a single woman, a single earner who's self-employed, is, fairly high average tax rate. By comparison, just pulling my own tax return, I'm not going to tell you my numbers, but I will say I come from a dual income household. I earn money with my business, Sunlight Tax. My husband is also an earner, but we do not have 100% of our household income subject to self-employment tax, because only half of us, me, all of my income is subject to self-employment tax, but my husband is an employee, right? So he does not pay self-employment tax on all his income. He's just paying that 7.65% tax into Medicare and Social Security, right? And we have kids and we get a pretty juicy tax credit for our kids. So 2 child tax credits, and we also have a dependent care tax credit. I just scanned through what our total tax credit. Some years we do even better. If the year we bought an electric car, we got a great tax credit. So you might have more or fewer tax credits yourself, but we have those too. And those kids, that is a real incentive to help families under US tax law, and we benefit from it. So with our income, which is higher than this client I just pulled out for you, we actually pay a lower tax rate. Our tax rate, when you divide our total tax by our total income, it comes out to 18.5%. So when I spend $100 in Sunlight tax, I save $18.50 on that 100, okay? Unlike my client who I just told you about, who saves $25, okay? Now, these are fairly close together, right? But her savings is actually a little higher than my savings. It still benefits me very much to, have deductible expenses in my business. But there you go. That's the summary. So the quick tip version here, look at your total tax, line 24, and divide that by your total taxable income, line 15 of last year's tax return. And that shows you last year's average tax rate. And that is your savings when you take deductible business expenses. All right, so moving on. What do you actually want to spend your money on? Well, that's really up to you. Anything that is ordinary and necessary in your business is something deductible for your business, and you will, that spending is sheltered from taxes. Okay. Okay, so you want to make sure that you're buying things that are useful to you in your business, that have genuine value to you, and that you're not just spending a bunch of money to get the savings, because you're still spending money, right? Even if you get $25 savings on every $100 that you spend, you're still spending $75 of your money. And you might need to be more conservative depending on your financial situation. So don't make stuff up. Only buy things that are genuinely valuable to you. But this is a great time of year to accelerate your expenses that you're going to incur. If you know you need a new printer, if you know you need a computer, one, you can be taking advantage of those great end of year, holiday sales, but also you can help lower your taxes for this year. So it is a great time of year to do those larger investment purchases, like bigger pieces of equipment. And also if you have places, people in your life who send you invoices who allow prepayment, this is a great time for prepayment. So maybe you have a package with your lawyer, for example, and you can prepay now for services you'll receive in 2025. Maybe you buy a coaching package. Not to sound too self-interested, but my program, Money Bootcamp, you could certainly go into that category, of an expense that you would get the full deduction now, and then the benefit, because it's a lifetime program, would go for a long time, right? So whatever it is, this is a good time to assess things you might be planning on purchasing, and if you have the cash, buy them now. Okay? All right. So I hope that's really helpful to you to think about accelerating your expenses, deferring your income as a way to lower this year's taxable income. And I hope also that tip about how to calculate the actual average tax rate that you pay, and therefore what your savings is dollar for dollar when you spend money in your business, I hope that was helpful. If it was, please share this episode with a friend who could use it too. All right. And then speaking of, one more thing I want to just mention as we approach the end of this year is this one very important deadline. I think if you've listened to this podcast for a while, you've already heard this, but there is a new rule from the US Treasury. It is an anti-money laundering rule, and it's a really good thing, but every person with an LLC plus any entity that you form through a filing with your Secretary of State. So you may need to check your own state's rules. So this will apply to some people who have a doing business as, a DBA. Some states that actually forms an entity. So you have to be a little careful. It's a little more fine-grained than just LLCs, but all LLCs, with a very few exceptions, are required to file an information report. It's free, there's no money, and it's not very hard to do. It really only takes a few minutes, but this is called a beneficial ownership information report. It's mandatory, it's required. Your deadline, if you have a pre-existing LLC, is December 31st, 2024, or else you will face $500 a day penalty, up to $10,000, and up to 2 years in prison. So the penalties are very, very real, but the report is quick and it's easy and it's free. And I have a little short 15-minute mini course on how to do this filing, just so that you make sure you tick off this absolutely mandatory thing you need to be doing in your business if you have an LLC or an entity that you form through your Secretary of State. Okay, so if you want to get that totally free course and, avoid scams, because a lot of scams are going out about this BOI report, you can get that course at sunlighttax.com/LLC. One more time, that's sunlighttax.com/LLC. All right. That's it for my year-end quick tips for today. Next week, I will be talking to you about charitable contributions. At year-end, it is a big deal. You're probably getting lots of solicitations. So next week, I will be covering that for you, and I will see you next week. Take care. Bye. Thank you for watching. If you like this video, be sure to like, leave a comment, and subscribe to my channel. I'm so grateful for that. This video is for education and entertainment only. Nothing in this episode should be taken as individual tax or financial advice. You can find all the tools, books, and links I reference at sunlighttax.com/podcast.